Celestia Quicks has a resume that includes auditing Verizon's own stores for compliance, which, in retrospect, may be the most ironic hiring decision in telecom history.
That background is exactly what makes the documentation here so detailed. Today, we're covering a dispute that spans federal privacy law, billing contradictions, and what happens when a corporation runs its standard playbook against someone who helped write it.
Let's start with the dispute itself, the attrition strategy, the numbers that keep changing, and the CP&I breach at the center of it all.
The post titled Telecom Trap Part 2 opens with a formal addendum to an ongoing case timeline. And the core allegation is that Executive Relations Representative Malika Finnis is running a deliberate strategy designed to outlast a terminally ill customer with a September 2026 prognosis.
The quote that frames everything is direct. They tried to use their corporate playbook against the woman they hired to help them enforce it.
What that means in practice is that the standard corporate attrition tools, duplicate template responses, conflicting balances, the $605 FCC formal complaint paywall, are being deployed against someone with firsthand knowledge of how those tools function.
And the billing numbers are where it gets genuinely hard to dismiss as clerical error.
3 simultaneous figures were in circulation at once. On July 7th, Verizon told the FCC the account balance was $0. Simultaneously, a paper statement arrived demanding $17.19 marked due immediately. And via FedEx overnight, a separate demand for $121.66 arrived, claiming it was final and would not be adjusted.
3 balances, 1 closed account, 0 phones in the customer's possession.
The forensic audit in Part 2 traces exactly how the $17.19 figure was constructed. The real first invoice was $121.47. The printed past due anchor on the paper statement was $101.62, a difference of exactly $19.85 with no corresponding transaction record. A partial credit of negative $84.43 was then applied, producing the $17.19 figure. The post states plainly, the math can never make sense because it was back-engineered.
The underlying privacy claim is a violation of 47 U.S.C. Section 222, which governs customer proprietary network information. The allegation is that employee FEL accessed account records without an open service ticket, and that the automated security flag this triggered was subsequently mischaracterized as an internal system error to avoid filing a formal breach report. The semantic precision Malika deployed is actually documented. She claimed there were never any security locks or holds on the account, while simultaneously acknowledging a system flag that caused account suspension. The post calls this a deliberate word game, distinguishing an account lock from a network routing flag on the phone number itself.
And the downstream consequences of that flag were concrete. AT&T rejected a new service activation citing a security concern. The FCC's own online complaint form blocked submissions. Google flagged the account for unusual traffic. Part 2 walks through the technical chain. The flagged number auto-populated into Google Payments through normal account use, and removing it restored search functionality.
Which rather directly contradicts Malika's claim that whitelist tokens only apply to businesses managing digital wallets, given that Verizon Wallet appears in the customer's own account dashboard menu.
Part 3, Telecom Trap Part 3, the Verizon Impasse, covers Verizon's official FCC response letter from a representative named Beatrice dated July 13th. That letter claims a comprehensive resolution package was sent via FedEx on July 8th. The post states what actually arrived was a duplicate photocopy of Malika's earlier BBB response letter and a closing notice. The July 13 letter also attempts to justify the $17.19 residual as reconnection and late fees. Verizon's reconnection fee is $25. Their late fee is $10. Neither figure produces $17.19, and the post notes there was no service disruption that would have triggered a reconnection in the first place.
The conflict of interest point in Part 3 is the one that tends to linger. Malika, who issued the June 17 letter classifying further complaints as a business disruption, is the same person who subsequently conducted the internal forensic audit of the formal FCC and BBB complaints filed against her own conduct.
The formal rebuttal filed in response argues that the billing timeline itself disproves Verizon's claim that this was a standard postpaid account. Activation was May 28, first bill due June 19. 22 days later. On a legitimate postpaid structure, the first bill would not be due for 50 to 60 days. The rebuttal argues this misclassification under a pay-in-advance hybrid structure is what caused the 2FA shortcode failures, and that a simple correction to the account type would have resolved the issue without any of the subsequent escalation.
The BBB closed the complaint on July 15. 2 minutes later, another response from Malika arrived. That timing is documented in Part 3. The pattern the posts establish, duplicate letters, self-investigation, balances that shift between 0 and 3 different figures depending on the channel, points toward the next question, which is what regulatory remedies remain open when the internal process has been exhausted? What stays with you is the compliance audit background being the exact tool needed to document what a compliance audit is supposed to prevent.
The federal clock is still running. Next time, we'll see where the paper trail lands.